March 12, 2025, was a day of wild swings on Wall Street. The markets opened higher, with the S&P 500 initially jumping 1.3%. However, the gains were short-lived. By the closing bell, the S&P 500 had reversed course, ending the day down 0.3%. The Dow Jones Industrial Average experienced even more dramatic fluctuations. It swung between a gain of 287 points and a loss of 423 points before finally closing down 346 points, or 0.8%. Amidst the turmoil, the Nasdaq Composite, heavily weighted towards technology stocks, managed to eke out a 0.2% gain. The roller coaster ride on Wall Street was a direct result of escalating trade tensions. These tensions had been simmering for weeks, but boiled over following the announcement of new tariffs by the Trump administration. The uncertainty surrounding the future of global trade sent shockwaves through the markets, leaving investors scrambling for safety. The day's volatility was a stark reminder of the interconnected nature of the global economy. When one of the world's largest economies, like the United States, makes a significant policy change, the ripple effects are felt far and wide. The question on everyone's mind was whether this would be a temporary blip or the start of a prolonged period of market instability. The Trump administration's decision to impose a 25% tariff on imported steel and aluminum was the catalyst for the day's market turmoil. These tariffs, a cornerstone of President Trump's economic policy, were aimed at protecting domestic industries from what he deemed unfair competition. However, the move was met with immediate condemnation from trading partners around the world, who argued that the tariffs would harm their economies and lead to higher prices for consumers. The tariffs were the latest salvo in President Trump's ongoing trade war, a signature policy that had already roiled global markets and strained relationships with key allies. Despite warnings from economists and business leaders about the potential negative consequences of protectionist trade policies, President Trump remained steadfast in his belief that tariffs were necessary to protect American jobs and reduce the trade deficit. The imposition of tariffs on steel and aluminum was seen by many as a shot across the bow of China, the world's largest producer of both metals. The Trump administration had long accused China of unfair trade practices, including intellectual property theft and currency manipulation. By targeting steel and aluminum, two industries that were heavily subsidized by the Chinese government, the Trump administration hoped to pressure China into making concessions on trade. The European Union, a staunch advocate for free trade, was quick to retaliate against the Trump administration's tariffs on steel and aluminum. The EU announced retaliatory tariffs on a range of American goods, including iconic products like bourbon whiskey and Harley-Davidson motorcycles. The move was designed to inflict economic pain on key industries in states that were politically important to President Trump. The EU's Trade Commissioner, Cecilia Malmström, condemned the Trump administration's tariffs as illegal and protectionist. She argued that the tariffs would harm businesses and consumers on both sides of the Atlantic and would do nothing to address the underlying issues in the global steel and aluminum markets. The EU's decision to retaliate against the United States marked a significant escalation in the transatlantic trade war. The two sides, which had long been close economic partners, were now locked in a tit-for-tat battle that threatened to undermine the global trading system. As the trade war between the United States and its trading partners escalated, companies on both sides of the Atlantic found themselves caught in the crossfire. Companies that relied on imported steel and aluminum, such as automakers and manufacturers, faced higher input costs, which they were forced to pass on to consumers in the form of higher prices. The tariffs also disrupted supply chains, as companies scrambled to find alternative sources for their raw materials. The uncertainty created by the trade war made it difficult for businesses to plan for the future, leading to a decline in investment and hiring. Among the companies hardest hit by the trade war were those that were targeted by retaliatory tariffs. Brown-Forman, the maker of Jack Daniel's whiskey, saw its stock price plummet after the EU announced tariffs on American bourbon. Harley-Davidson, another iconic American brand, also faced significant headwinds as a result of the EU's tariffs on motorcycles. While the broader market grappled with the uncertainty created by the trade war, one sector offered investors a glimmer of hope: artificial intelligence, or AI. Stocks of companies involved in the development and application of AI technologies surged on March 12, 2025, bucking the downward trend in the overall market. NVIDIA, a leading maker of graphics processing units or GPUs that are used extensively in AI applications, saw its stock price jump by 5.1%. Supermicrocomputer, another company that provides hardware for AI systems, experienced a 4.2% gain. These gains were driven by the belief that AI would continue to be a major driver of technological innovation and economic growth, regardless of the short-term fluctuations in the market. Tesla, the electric vehicle and clean energy company led by Elon Musk, also saw its stock price rise by 6% on March 12, 2025, marking its first back-to-back gain in a month. While Tesla was not solely an AI company, its heavy investment in autonomous driving technology placed it squarely within the sector's orbit. In a rare piece of positive economic news on March 12, 2025, an encouraging inflation report showed that price pressures in the United States were starting to ease. The report, which came as a welcome relief to investors who had been bracing for signs of runaway inflation, showed that the Consumer Price Index, a key measure of inflation, had risen at a slower pace than expected in February. The slowdown in inflation was attributed to a number of factors, including easing supply chain bottlenecks, a cooling housing market, and waning consumer demand. The Federal Reserve, the central bank of the United States, had been aggressively raising interest rates in an effort to tame inflation, and the latest report suggested that its efforts were beginning to pay off. However, the positive news on inflation was tempered by concerns that the tariffs imposed by the Trump administration could lead to higher prices for imported goods, which could reignite inflationary pressures. The bond market, often seen as a barometer of investor sentiment about the economy, also reacted to the day's events with a degree of nervousness. Treasury yields, which move inversely to bond prices, rose slightly on March 12, 2025, indicating that investors were demanding a higher rate of return on their investments in U.S. government debt. The 10-year Treasury yield, a closely watched benchmark for mortgage rates and other borrowing costs, climbed to 4.3% from 4.28% the previous day. This upward movement in yield suggested that investors were starting to factor in the potential for the trade war to have a negative impact on economic growth. A prolonged trade war, with its attendant uncertainty and potential for retaliation, could lead to a slowdown in economic activity, as businesses become more cautious about investing and hiring. This, in turn, could lead to lower demand for credit, which would typically put downward pressure on interest rates. However, the potential for tariffs to stoke inflation could complicate the Federal Reserve's efforts to manage the economy. The shockwaves from the escalating trade war between the United States and its trading partners were felt in financial markets around the world. European markets, which had closed before the full extent of the market turmoil in the United States became apparent, initially opened higher on March 13, 2025. However, the gains were short-lived, as investors digested the news of the escalating trade tensions and the potential for further retaliation. Asian markets, meanwhile, experienced a mixed session, with some indices ending the day higher while others closed in negative territory. The varying reactions in global markets reflected the complex interplay of factors at play, including the specific exposure of different economies to trade with the United States, the outlook for global economic growth, and the perceived risk appetite of investors. The most significant casualty of the escalating trade war between the United States and its trading partners was perhaps not the immediate fluctuations in financial markets, but the erosion of certainty and predictability that are essential for businesses to thrive and for economies to grow. The unpredictable nature of the Trump administration's trade policy, characterized by sudden pronouncements, reversals, and threats, had created an environment in which businesses were reluctant to make long-term investments or to hire new workers. This uncertainty, coupled with the potential for further retaliation and escalation, cast a long shadow over the global economic outlook. The trade war highlighted the interconnected nature of the global economy and the dangers of protectionist policies. In an increasingly integrated world, Tariffs and other barriers to trade harm not only the countries that impose them, but also their trading partners and the global economy as a whole. A